Very good afternoon, good morning. Welcome to HYCM's workshop with myself, Giles Coghlan. I do hope everybody is doing well. Good to see you here. Alitza, Brian, Gabriel, Marco, Mustafa. Good to have you on board. Looking forward to this workshop in particular because we've got some really important data points coming up on Friday. And I'm going to show you exactly what I'm looking for with them. There's likely to be some significant volatility on two significant data points on Friday. I'll run through them for us. Just as other folks are signing in, don't forget, as I look at different instruments, different trading, currencies, commodities, indices, the whole idea of this workshop is that it's an educational workshop. You're looking over my shoulder, seeing how I'm going about approaching the market. This isn't trading advice. Indeed, it can't be because market conditions change so quickly that this is not a trading advice workshop. We are looking at the preview and plan for the US core PCE print, and as a bonus, I'm also going to throw in the Eurozone inflation. We've had some significant developments out of the ECB increasingly over the last few weeks. So I will be making sure that we're up to speed and ready to know what to expect in terms of market dynamics for both the Fed's preferred measure of inflation, which is the core PCE print, and what the ECB have now told us is what their focus is on the core inflation print. So without further ado, let's go over and start making sense of these narratives. Now, this morning, the first thing to say, we have had some hawkish developments out of the ECB, with them reportedly mulling a faster reduction of bond portfolios. So what they're going to do is, once the TLTRO loans are paid back, some people are thinking, well, maybe we could accelerate the APP, the asset purchase program, and pay those back more quickly. So this is a more hawkish move. And on top of that more hawkish move in terms of this is basically quantitative tightening. A quantitative easing is pumping money into the economy. This is sort of taking easy money out. So it's quantitative tightening. That's more hawkish. And if you look at the sort of speakers we're having increasing out of the ECB, they're sort of saying, yes, we want to hike rates in July and maybe more. And we saw another sort of more hawkish chat coming out of the ECB with Vucic saying there's a good chance of a hike in September. Vasley says he needs convincing that rate hike beyond July is not needed, not that it is needed. In other words, he's more convinced that we need to see higher interest rates. And that makes sense because if you look at the projections for the ECB, in terms of the core inflation coming on Friday, look what they're projecting for the core. They're expecting the core to come in at 5.5%, up from the prior 5.3%. So first thing to note, they're actually expecting the core to be stickier. Now, if you recall the last ECB meeting last week, what the ECB told us is that this is the most important inflation reading that they're looking at, not the headline, the core. So already the fact that economists are projecting this to increase up to 5.5% is sending a strong message. So if you look at the core inflation prints around the world, you can see that the euro area, the last core inflation print was 5.3. It's now expected to go back in the wrong direction up to 5.5%. So what that means for the euro is really quite clear. If we see a disappointing print come in for the Eurozone core inflation metric, that will mean there's less likelihood of the ECB needing to hike interest rates beyond July. If you look at short-term interest rates at the moment, what you'll see is that markets are expecting one more interest rate hike in the next meeting coming up in July. That's kind of nearly 100% priced in, 88%, and the ECB have pretty much said that they're going to do this. But beyond that, that's where it gets a little less certain. And you can see at the moment, short-term interest rate markets are seeing like an extra 12 basis points of interest rate hikes still due after September. after the July hike. So July hike is expected now or September by short-term interest rate markets, and the terminal rate is just under 3.85%. So what that means is the market's going to interpret this core inflation data in light of what it's going to do to the ECB interest rate expectations. So let's just take a look here. And let's just look at we'll just take this down, look at that in the US, that'll make it nice and easy for us. And what they're expecting is a higher print. So that's why we've had more aggressive ECB speakers coming out at the moment. And that's why we've been seeing the euro gain against the pound today. Let me just see, I want to get you a different chart. Yeah, I just want to use this chart rather than that one. So if you just take a look at the euro pound, we've been seeing the euro pound just gaining in value today because of that narrative, okay, that the ECB will need to be more hawkish. Now that euro pound is now pulling back up to that sort of broken trend line area. So prices at a very crucial place. If we move back below this level, you expect sellers to get back control. Back above, the bulls are in control for the euro pound. So what I'm looking for, I'm looking at potentially for a trade on the euro pound pair, depending on what we get with the Eurozone inflation. So if I see the core coming in below 5.1% and the headline coming in below 5.3%, and the other metrics on expectation, so I want to see below 5.1 for the core and below 5.3 for the headline, then I would expect that means the ECB will need to do less in terms of hiking interest rates. I expect to start seeing some of these interest rate moves beyond July to start getting priced out. Okay, and I expect this short-term interest rate move to drop lower, and that I would expect to boost the euro pound. So in that instance, I would look at a potential euro pound upside, and I'd be looking to measure risk depending on where price is when we get to Friday, and the obvious target would be up to that sort of 0.8700 region, just underneath it, where we have the 100 and 200 exponential moving average on the daily euro pound chart. Okay, so there's a very clear resistance level there, and you see you've got support, 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 resistance. If you just draw your support and resistance levels in, you'll see, look, support, 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 broken support, becomes resistance, and then that's likely to become resistance again. We've got that 100, 200 exponential moving average. So if you put this as a whole region, you know, you've got a big resistance area above. So that would be an obvious target for buyers. Now, the other opportunity is, say the print comes in much low. Sorry. Now, let me just explain this to you. I've just got confused there. Please excuse me. So if the print comes in low, I would expect the euro to move lower. If the print comes in high, I would expect the euro to move higher against the pound. So the outlook I just gave you for the euro gaining would actually be on a high print. So make sure you understand that. I just got confused there. Sorry about that. The euro, you'd expect the euro to gain against the pound if the core print is higher, because it means the ECB has to be more aggressive in terms of hiking interest rates. So what I'd be looking for a euro pound buying scenario, I'd want to see the core above 6%, the headline above 5.9%. So just to be clear, for euro pound upside, I want to see the core above 6% and the headline year on year above 5.9%, because that shows inflation moving in the wrong direction. And that shows the ECB will have to be more aggressive. And so that would lift the euro against the pound, and I'd expect to retest up to that 0.8700 region. Okay, sorry about that, folks, getting confused there. However, the opposite is also true. If this comes in lower, I'd expect the euro to lose value. And you could either trade euro US dollar or euro pound. Wouldn't really matter. Euro US dollar could be quite attractive, or euro pound. But what I need to see is a miss. I want to see the core coming in below 5.1. I want to see the headline coming in below 5.3. If I see that coming in below 5.1 and the headline coming in below 5.3, I would expect to see a drop in the euro in expectations that the ECB needs to do less, as you expect euro pound to fall lower. And you can just see that there's a really key area here, and you could potentially look for a move back down into this region down below. Now that's the ECB's, and they've said, the ECB have said that the core inflation print is what they're looking at. Now the Fed, since 2012, the personal consumption expenditure print has been the Fed's preferred measure of inflation. In other words, if the Fed want to know how inflation's going, how the inflation battle is, they look at this PCE print, and this core PCE print is crucial. Central banks around the world have been struggling with a stickier core inflation metric. The Bank of England had to hike by 50 basis points last week because of its Swiss National Bank, concerned about the second round effects of inflation, hiked interest rates with strong hints that there may be more to come. And we saw the Australian dollar lose value overnight as Australian data regarding inflation showed a drop in the latest monthly inflation print. So, the RBA may have to do less. So the Fed's going to respond exactly the same way. If this is high, expectations will increase. The Fed needs to do more. You'd expect to see dollar gains, 10-year yield gains, gold falls, US stock falls. If this is low, it means the Fed needs to do less. So you'd expect to see the dollar falling, yields falling, gold rising, US stocks rising, because lower interest rates are more conducive for US companies, and particularly rate sensitive indexes like the NASDAQ, you'd expect to move higher if this is a miss. So in terms of what to expect, there's some interesting things to note here, what to expect. So if the core PCE comes in below 4.6%, so if it's 4.5, and say the year on year is 4% or lower, so year on year core below 4.5, headline 4% or lower, then I would expect a sharp move lower in yields. I'd expect a sharp move lower in the dollar, and the instrument I'd look to trade would be gold, and I'd look for gold upside. Now gold's coming into some very, very interesting areas now. Okay, we've got a pretty decent support level around this 1900 region, and I'd expect to see gold upside if this core PCE print is a big miss to the downside. So definitely one to watch. We saw this symmetrical triangle break out to the downside. We've had an attempt at a move higher. We're moving back down through this sort of support. It says resistance, comes of support, resistance, and what this level becomes now is going to largely depend on this PCE print. So just notice these key sort of support levels that we have marked on the chart. And if we get a big miss in that core PCE print as outlined, I'd expect gold to move to the upside. Now, the converse is also true, because if this comes in much higher than the market's expecting, then we're going to see more expectations for an aggressive Fed. Now, at the last dot plot, the Federal Reserve kind of indicated that they've got more interest rate hikes to come with a dot plot which showed a median dot plot around 5.375%, I think it was, or maybe 5.6%. So the dot plot, yeah, it showed 2 more rate hikes to come. Now, short-term interest rate markets are only showing 1 more interest rate hike to come, but no cuts this year. Now, that's changed because previously the short-term interest rate markets were expecting the Fed to cut rates this year. Now they're not. So they're saying one more interest rate hike this to come, and then they're expecting to see interest rate levels to fall into next year, with a rate cut expected around spring, May of next year. So if the print is very, very high and comes in above market's maximum expectations, then what investors will start to think is, oh, the Fed's going to need to be higher for longer. Maybe short-term interest rate markets will start pricing in another rate hike after July's meeting. So in that instance, if we get very high PCE data coming out on Friday, this comes in hot, and we get the headline coming in 4.7%, so 4.8% for the core reading year on year. And if we get the headline coming in above the prior, and remember the prior for the PCE print was 4.4%. So if we see 4.8% for the core year on year and 4.5% for the headline, then what we'd expect is the dollar to gain. So you could potentially look at dollar yen upside, but I'll explain why there's risks with that in a moment. You could also look at potential gold, more gold downside. So I think if you wanted to keep it simple, gold would be the instrument, because gold's really been is strongly driven by the dollar, yields, and inflation expectations. So if there's a big beat in the core PCE print, that will indicate the Fed needs to do more, higher yields, higher dollar, and that should push the dollar, should push gold rather down to around that 1900 region. So look at this area. If we're not down that region by Friday, I'd expect to move lower. And of course, if that lower level breaks, then we could potentially look at a significant run back down to that 1850 region. So that's definitely something to be very carefully looking at as we move forward. You can see we sort of really starting to accelerate the downside and got major support around that 1840 region on the weekly chart. So gold will keep moving lower if we keep seeing higher interest rate expectations, because you expect yields to rise, the dollars to rise. Now, yes, if there's a big beat in the inflation data, you might expect dollar yen to move to the upside, but there's a problem with that. And the problem with that is that the Bank of Japan do not want to see the yen weaken any further. And the Bank of Japan get very, very worried when the Japanese yen gets around that sort of 145 region. So watch out, because we could get the Bank of Japan intervening over a risk event. So you could see the Bank of Japan intervening and selling the dollar yen. So they'll be buying the yen when we're around that 145 region. We've already seen sort of significant concerns coming from the Bank of Japan, and if you just take a look at, you'll see that we've had a number of speakers coming out. Let's just see where this is. Let me just see where we are. I need to find this headline. They're just talking about concern. They don't like it. It may come under FX intervention. Yeah, here we go. Japanese closely watching FX moves with high sense of urgency, sudden and one-sided moves seen in FX markets. So, Japan's top FX diplomat, Candace, says, will respond to FX moves if moves become excessive, and FX should move stably, reflecting fundamentals. So what they don't like is they don't like seeing the dollar yen just sort of moving higher, and they don't like the dollar yen moving above that 145 region. So you can see, in the recent sort of times, once the dollar yen gets to that 145 region, we're seeing markets selling off, and we're in a very similar environment now. Markets don't like these; they don't like these aggressive and excessive moves, and they're unlikely to allow that to keep going. So with the dollar yen, just watch out for if it goes 145 higher on a really high inflation print. So just to summarize, let's go through what I'm expecting so it's all really clear. Eurozone, US. Right, so headline inflation for the ECB, if headline core inflation comes in higher than the market's expecting, then I would expect euro pound to move in line with the interest rate expectations. That higher inflation means more likely the ECB will hike interest rates, and so you'd expect the euro pound to gain. If it's very much lower than the market's expecting, you'd expect the euro pound to fall. With the PCE print, if this comes in high and a large print, you'd expect the dollar to gain, gold to fall, yields to rise, and US stocks to fall in higher interest rate expectations. And you'd also expect the opposite. The best opportunity that I see is if we get a miss in either of these two. Why? Because markets have been pricing in higher inflation. So if we start to see inflation missing targets, that's likely to see the best reaction. And the best reaction is from the Fed. And the best instrument I would look for a miss would I'd expect significant gold upside if that core inflation print comes in below 4.5% and the headline comes in at 4.1% or lower. So 4.5% for the year on year, 4% or lower for the headline. And as long as those other twos are around sort of market expectations, then I would expect significant upside potentially in gold, and look out for the prior revisions. Okay, folks, that is everything. So that's got us up to speed. These are the two best trading opportunities this week that I can see. There isn't much better economic data points, and markets have been quite sort of, treading water, waiting for these two events. Okay, folks, I do hope that's been helpful, and I hope that you can make sense of that. If there's any questions, please do let me know in the chat box or ask me. Yeah, Marco, no worries. Yeah, Mustafa wants to look at the chart of natural gas. Absolutely, we can look at that, Mustafa, no problem at all. Now natural gas tends to normally lose value around this time of the year. If you just look at it from a seasonal perspective, what you'll see is that natural gas tends to fall around this time of the year, and you'll see from a seasonal perspective, after over the last sort of 15-20 years, you'll see this tends to be sort of a weak period for natural gas, right? It tends to fall. Now, at the moment, natural gas is not particularly weak, and that's just because of the Russian-Ukraine crisis and the supply issues that there are with natural gas. So you can have a look here. You can see that natural gas is sort of trying to bottom out at the moment, and a lot of the sort of Russia-Ukraine problems has been resulting in natural gas, sort of surging significantly higher. So that's really the issue that's been going on with natural gas. Yeah. Okay. So what I'm seeing, so from a fundamental point of view, this could suddenly move higher on some kind of natural gas supply issue. So if I was just looking at trading this technically, what I'd look at is I'd look at this kind of structure here, and so I wanted to go long, or it would be long, but I'd have my stops the other side of 2.11, because if price moves back down there, I know that something's gone wrong. I'm not trading natural gas, and the obvious take profit would be up at that 4 level, okay? But as I said, usually this is a time of weakness for natural gas, but you can see that weakness seasonal pattern hasn't been playing out, and that's all because of the supply problems with Russia, Ukraine, and supply to Europe, and Europe's been scrabbling around for natural gas, And you see, look how volatile natural gas has been. With normally natural gas, doesn't see these kind of levels, up to, wow, just under 10. Yeah, okay, Brian, thank you very much. So Brian just says, help make sense of gold for me. I didn't see what you meant about yield. I should give you one chart that should solve this problem for you. And if you have a look, Brian, on the HYCM blog, I'm going to send the link to you, right? And if you spend some time, just go onto my blog. It's not my blog, it's HYCM's blog, but I provide a lot of the material for it. So that's why I slip sometimes and call it my blog, because I write articles almost every day. Look in the search bar, type in gold, trading gold, okay? And then you'll see this explained. So basically, what I'm using here is a TIPS. Now, this is a Treasury Insurance Protected Security, Inflation Protected Security. So in other words, this is the measure of a US bond yield minus inflation expectations. It's kind of like the real yield. So this is all explained in the blog in more detail. So, grab a coffee, sit down and spend an hour and you should have your head around it. But I'll explain it now, so this will start the process going. Gold is in the yellow, right? The dollar's in green, and this proxy for real yields is in the blue. And notice, when you see real yields falling, so in other words, when inflation is eating into a yield, when you start to see real yields falling and the dollar falling, that lifts gold. So do you notice, when you see real yields rising and the dollar rising, you see gold falling. And recently, we've been seeing, haven't we, like real yields have been rising in the last sort of couple of months. The dollar's been rising, through May, and so gold was falling. And at the moment, we've still got that general move. Real yields are falling, the dollar's falling. But I'm expecting yields to turn over. I'm expecting the dollar to turn over. So I expect gold to start rising at some point. But just notice this relationship for now. When you have real yields falling and the dollar falling, gold gains. When you have real yields rising and you have the dollar rising, you see gold falling, okay? So rising real yields, rising dollar, falling gold. If you have a look at my blog and just search it, gold, trading gold, I go into it in more detail. Instead of like tips, the thing about the tips is it's updated into market in the US session, whereas the real yield is only updated once a day. So it's fine if you've got a big, time frame and you're sort of trading weekly, monthly stuff, you'll be fine with real yields, Brian. But if you're doing anything intraday, you'll look at tips, or you could just look at the bond yield as a shortcut, and that would just be like looking at US 10-year yields. So this is where you put the if you did trading gold in the search, and then you'll see 4 things to know about trading gold right now. How can you use the gold? That's worth looking at as well. Okay. And then you can see how, I was looking at this same narrative. I was looking to trade that in April. So you'll start to get a feel for the way I'm looking at things. Yeah, that's great, Brian. Super. I hope that helps. Okay, thanks. Thank you all very much. It's been a good session, and Friday should be a fantastic day with lots of volatility in the market. So do keep an eye out for that. Thanks everyone now. Take care and goodbye.